Just a few days ago, silver was trading above $70. Then it slipped to $67. Today, it briefly touched $63. If you're trying to figure out what caused such a dramatic move, and more importantly, where silver could go from here, you need to understand the three major developments that collided this week. What surprised me is that most financial media outlets are covering these events separately, but almost nobody is connecting them together. Yet when you look at all three pieces as part of the same story, the picture becomes much clearer. The first event came from the Federal Reserve on Wednesday. The second arrived from Switzerland today. And the third is happening quietly in the physical silver market, largely unnoticed by mainstream coverage. Once you see how these factors interact, the recent price action starts to make a lot more sense. Let's begin with Wednesday, because that was the spark that set everything in motion. On Wednesday afternoon, Kevin Warsh stepped in front of the cameras for his first Federal Reserve press conference as chairman. The interest rate decision itself wasn't surprising. Rates remained unchanged at 3.50% to 3.75%, and the vote was unanimous. Going into the meeting, silver had already recovered strongly from its June 9th low near $61 and had climbed back above $70. Markets were relatively calm. Then the updated dot plot was released. Back in March, the Fed's projections still showed one rate cut expected before the end of 2026. That expectation had quietly supported precious metals for months. But the new projections changed the story entirely. The anticipated cut disappeared, the median year-end rate forecast moved higher, and for the first time, a significant number of Federal Open Market Committee members began projecting at least one rate increase before December. Just 3 months earlier, none of them were expecting that outcome. Markets reacted immediately. Treasury yields jumped. The US dollar surged. Expectations for tighter monetary policy rose sharply, and silver quickly fell from around $70 into the mid-$60 range. But there was another detail from Warsh's press conference that received far less attention, and it may prove even more important. Traditionally, Fed chairs submit their own interest rate projection as part of the dot plot. Warsh chose not to. Instead, he argued that individual projections were no longer helpful under current conditions. He also signaled the end of the Fed's long-standing forward guidance approach. In simple terms, the message was clear. The central bank no longer wants to provide a roadmap for future policy decisions. Markets will have to rely on incoming economic data rather than pre-announced guidance. Warsh didn't stop there. He announced the creation of 5 separate task forces designed to review key areas of Federal Reserve operations. These groups will examine communication strategy, balance sheet management, data collection practices, the impact of artificial intelligence on employment, and even the framework used for inflation targeting itself. That announcement suggested something much bigger than a routine leadership change. It signaled a broader review of how the Federal Reserve operates and communicates with markets. This is why Wednesday's reaction was more severe than a typical hawkish Fed meeting. Investors weren't simply responding to higher rate expectations. They were also adjusting to a future where the Fed may provide far less guidance than it has for the past decade. Then came today's development, which added an entirely different layer of uncertainty. Throughout the week, investors had been watching progress surrounding the US-Iran agreement. A digital framework had already been signed, creating optimism that tensions could continue easing. A formal ceremony was scheduled for Friday at the Burgenstock resort in Switzerland, where representatives from multiple countries were expected to finalize the process. That meeting never happened. Late Thursday, reports emerged that Vice President J.D. Vance would no longer travel to Switzerland. Soon afterward, Swiss officials confirmed that the planned discussions had been postponed. No replacement date was announced. According to multiple reports, the delay followed renewed regional instability after overnight military activity involving Israel and Lebanon. The changing security situation reportedly caused Iran to postpone sending senior officials to the event. And suddenly, the market found itself dealing with 2 separate shocks at the same time. A much more hawkish Federal Reserve and fresh uncertainty surrounding a geopolitical agreement that investors had been counting on. That's how silver moved from optimism at the start of the week to heavy selling pressure by Friday. To really understand what happened this week, you have to step back and look at the full sequence. At the start of the week, silver was benefiting from optimism surrounding the Iran agreement. Investors were expecting a routine Fed meeting, tensions appeared to be easing, and confidence was gradually returning to the market. Then Wednesday arrived. The Fed delivered a much more aggressive message than investors expected. Rate cut hopes disappeared, Treasury yields surged, and the dollar strengthened rapidly. That alone was enough to pressure silver prices. But before markets had time to fully digest that shock, the Switzerland meeting was postponed. The planned ceremony was supposed to reinforce the idea that geopolitical tensions were moving toward a resolution. Instead, investors were left with uncertainty and no clear timeline for when discussions would resume. The result was a sharp shift in sentiment. Silver began the week supported by hopes of lower tensions and stable monetary policy. It ended the week facing renewed geopolitical uncertainty, a stronger dollar, higher rate expectations, and a market suddenly questioning what comes next. Yet there is something extremely important that many people are overlooking. This is not the first time silver has faced a combination of monetary policy pressure and geopolitical disruption this year. Back in January, silver experienced a historic collapse after the market reacted to Kevin Warsh's nomination. Prices fell more than 30% in a single session. At the time, many investors believed the rally was finished. They were wrong. Silver recovered. Then came another major setback during April and May when concerns over the Strait of Hormuz, rising oil prices, and fears of tighter monetary policy pushed the market lower once again. Prices eventually reached their cycle low near $61. Again, many people assumed the story was over. Again, silver recovered. What makes this latest sell-off interesting is that despite multiple major corrections throughout the year, silver remains dramatically higher than it was 12 months ago. Even after one of the toughest weeks of 2026, the metal is still showing remarkable year-over-year gains. That tells us something important. The long-term story isn't being driven by weekly headlines alone, it's being driven by the physical market. And this is where things become extremely interesting. Today, COMEX warehouses hold approximately 86 million ounces of registered silver. Registered silver is the metal officially available for delivery against futures contracts. At the same time, the July futures contract represents more than 228 million ounces worth of potential claims. Think about that for a moment. There are far more paper claims than there is immediately deliverable silver sitting inside registered inventories. That imbalance did not change because of the Fed meeting. It did not change because of the Switzerland postponement. And it certainly did not change because traders suddenly became nervous for a few days. The physical delivery math remains exactly the same. In fact, delivery activity has been increasing significantly over the last several years. Compared with previous periods, more participants are choosing to take delivery rather than simply settle contracts financially. That trend matters because every ounce removed from the system reduces available inventory and places additional pressure on future supply. This is why many experienced silver investors continue monitoring warehouse inventories so closely. Price can move dramatically in either direction over short periods. Headlines can create panic. Central bank policy can change expectations overnight. But physical supply trends often move much more slowly, and they frequently reveal what's happening beneath the surface long before the broader market notices. That's why the next few trading sessions could be extremely important. While many investors will focus exclusively on political developments or Federal Reserve commentary, others will be watching something entirely different. Inventory movements, delivery requests, and signs of stress inside the physical silver market. Because ultimately, the most important question isn't whether silver experienced another volatile week. The real question is whether the underlying supply and demand picture has changed. So far, the evidence suggests it hasn't, and that may end up being the most important takeaway from everything that happened this week. Now let me tell you what I believe matters most going forward, because this is where investors need to separate short-term noise from long-term reality. Over the next several days, silver will likely remain highly sensitive to headlines. Any update regarding the postponed Switzerland talks could trigger immediate market reactions. A confirmed date for renewed discussions would likely be viewed as a positive sign for stability, while further delays could keep uncertainty elevated. At the same time, traders will continue watching Treasury yields and the US dollar. If yields remain elevated and the dollar continues to strengthen, precious metals could face additional pressure in the short term. But if those moves begin to reverse, silver could recover much faster than many people expect. Still, there is another factor that deserves even more attention: the physical market. Every day between now and the upcoming delivery period, inventory levels inside COMEX warehouses will provide valuable clues about underlying demand. If registered inventories continue shrinking while delivery interest remains strong, pressure on available supply could increase regardless of temporary price weakness. That is why I believe investors should avoid focusing solely on daily price swings. A move from $70 to $63 feels dramatic when viewed on a chart. But when you zoom out and examine the broader picture, you see a market that has already survived multiple major shocks this year and continues to hold well above where it traded 12 months ago. The bigger story has always been supply and demand. Global industries continue consuming enormous amounts of silver every year. Solar manufacturing, electric vehicles, data centers, artificial intelligence infrastructure, semiconductors, medical technology, and defense systems all require physical silver. These industries are not making purchasing decisions based on a Fed press conference. They are buying silver because they need it. At the same time, mine production continues struggling to keep pace with total demand. The result has been a recurring supply deficit that has persisted for years. That underlying reality did not disappear this week. The Fed meeting didn't change it. The postponement in Switzerland didn't change it. And market volatility certainly didn't change it. What changed was sentiment. Investors suddenly became more concerned about interest rates, economic uncertainty, and geopolitical developments. Those concerns affected prices in the short term, but they did not rewrite the long-term fundamentals. That distinction is critical. Many of the strongest rallies in silver history occurred after periods when sentiment was extremely negative. Markets often look weakest just before confidence begins returning. I'm not suggesting that prices immediately move higher from here. Volatility could easily continue. More uncertainty could appear. Additional surprises could emerge. But when I look at the factors that ultimately drive this market, I continue coming back to the same conclusion. The physical supply story remains intact. The industrial demand story remains intact. The long-term deficit story remains intact. And those are the forces that matter most over time. As we move toward the next delivery cycle, I will be paying close attention to three things: developments surrounding the Switzerland talks, movements in treasury yields and the dollar, and most importantly, changes in registered silver inventories. Those indicators will tell us far more about the future direction of silver than the majority of headlines circulating online. Before I wrap up, I want to address something for anyone feeling discouraged after this week's sell-off. A postponed meeting is not the same thing as a failed agreement. The framework that was already signed remains in place. Officials on multiple sides have continued expressing support for further discussions. The language used by those involved points to a delay rather than a collapse. That distinction matters. Markets often react first and analyze later. As more information becomes available, sentiment can change quickly. For now, silver remains caught between short-term uncertainty and long-term fundamentals. That tension is what makes the current environment so important. Whether you're adding to positions, waiting for additional confirmation, or simply observing from the sidelines, the next several trading sessions could provide valuable clues about where the market wants to go next. This is Ag John Silver Update, and I'll continue tracking every major development, every important inventory shift, and every key catalyst as they unfold. If this analysis helped you see the bigger picture behind this week's volatility, make sure to support the channel and stay tuned for the next update. The story is far from over, and the next chapter could arrive sooner than most people expect.